All right, everybody. I think we're ready to get rolling here. Thanks for joining us. This is another webinar in our series. We have another one coming up next month, year-end tax planning, and we again appreciate you guys for coming on the webinar today. This is going to be designed around charitable gifting strategies, and this webinar is designed to be informative in nature and not to recommend any strategy or give advice. There's a Q&A box. If you want to ask any questions at any point, we will be addressing all questions at the end of the webinar if you have any questions. And the host of this webinar, myself, Nick Faulkner, and I'd like to welcome on Chip Miller as well. And we'll be taking you through charitable gifting strategies today. And also, lastly, before we get going, we have a ton of charitable gifting information and resources on our website under the Insights tab. And you would be choosing the charitable gifting category. And we have podcasts, webinars, articles that we have a great selection of information there. So Chip, welcome. Thanks for joining us today.
Thanks, Nick. Super excited to talk about this topic it's very near and dear to our heart. It's one of those things as an advisor, and I know, Nick, you'll agree with this. It's really a privilege to help clients as they navigate through this specific role and understand kind of, and really see the impact that their gifts can have and be a part of that story. And it's just one of the joys that we're fortunate enough to have with clients. I think it's important to understand the role that we play as an advisor throughout this type of process with clients. And really, we consider ourselves a partner, and clients will come to us and say, hey, here's an idea that I have, first, can we execute this idea? What's the best way to do it? And how can we make the biggest impact? And so, we really partner with clients to go through pros and cons and think through exactly all the implications. Really, one of the big things I think is, helping clients get this level of confidence in knowing, okay, I can afford to make these, sometimes significant gifts and it not have a severely negative impact on your financial plan, your retirement plan. You don't want to give away money that you're going to need at some point in the future. So we help clients come up with that, that confidence that comes in knowing that, I can afford to make these types of gifts. And then we also think about it, you guys, anyone who's worked with us understands that we have a very tax-centric focus with our practice. And so we want to make sure that, if there are any tax benefits that are out there that are available to clients, we really want to take advantage of those the best we can. I mean, we're there are not a lot of, things that we get from the government in this area, but I think that it's, we want to maximize those things as we can. And Nick, I'll let you hit on the CARES Act a little bit, which is kind of a recent development, but it's something I think that's an important background.
Yeah, so we kind of wanted to go through this before we got to the actual charitable gifting strategies that we're going to outline in the next slide. But I think it's important to go through this. Congress enacted this in 2020. However, these rules apply till the end of this year, and they're kind of a few are really significant. The first one being that individuals who take the standard deduction can take charitable gift can deduct charitable gifts up to $300, and if you're married, $600. And really, this next one is maybe the biggest one, in that if you itemize your deductions, if you give to charities in cash, you can deduct up to 100% of your adjusted gross income for this year. And that's only in cash. It's not stocks, it's not property or any art or anything like that. It's just straight cash. So that's something this year that is still in effect for 2021 that can be a huge help, and that's kind of a significant change. And lastly, corporations can deduct up to 25% of taxable income if donations are made in cash. Again, that's Congress, and they're really key on the cash part, and that's up from 10% limit the year before. So these are just things to keep in mind. And if you want to talk this through with us, we're open and happy to talk about it as well. But I think these were important bullet points to highlight before we kind of got into the actual strategies today.
Yeah, and thank you for that, Nick. And maybe we can just go ahead and kind of launch into it.
Yeah.
I'll say that we really want to focus on a number of areas, right? So, I think that we want to talk about, should we gift appreciated stocks or mutual funds, and how does that work? I know one of the things, Nick, that we've hit on with podcast, and we've had another webinar just specifically on donor advised funds, right? It's a great tool that is in the arsenal for people who are charitably inclined. Also, the qualified charitable distribution is a tool that's out there that a lot of people are familiar with. It's relatively new, but it's kind of a nice option for people, especially those who are above the age of 72, who are taking required minimum distributions from their IRAs. And then, lastly, charitable trust, a direct charitable remainder trust. And that's really for people who are going to make larger types of gifts. Anything you want to add there, Nick?
No, I think that's a good outline. So we're going to kind of go double click into each of these topics, and then kind of go more in depth to each of these bullet points. And also, our phone lines are always open, email communications to go over these strategies on, if you try to figure out which one is best for me, that's something that we're, happy and open to talk about as well. But yeah, first we're going to talk about gifting appreciated stock or other assets to charity. And this, is one of the most popular, if not the most popular, way we see clients or other people in the industry donate or give to charity.
Yeah, it really is, and it's so easy to execute by and large. The charities themselves, whether it's a church or a community foundation or what have you, are super excited to receive these gifts. It's nice because if a taxpayer is itemizing their deductions, they can get a charitable deduction for this. And oftentimes what the strategy is to look in a portfolio and say, hey, let's gift our, some low basis stock. So maybe it's a stock that you bought, a number of years ago that's really done well. And, that's a good type of asset to gift. Some people gift real estate and other things. I mean, the options are kind of unlimited, but, it's easy to gift stock. You're kind of just transferring the shares over to charity, the church, or community foundation, or what have you. And almost always there's information on their website that says, hey, if you'd like to gift, shares of stock, here's our account number, here's our, routing number and things. And they're happy to make that happen. And one of the things that I think is really nice is, the charity themselves it's a nonprofit entity, right? So, you can take and transfer your shares of Amazon stock or what have you that has a low basis, and the charity then can just sell those shares and use the proceeds, and they're a nonprofit, so they're exempt from paying capital gains taxes on that. You have the benefit of that transfer, and it's just a really nice way to make that gift. It is notable that taxpayers are allowed to deduct up to 30% of their adjusted gross income. So for larger gifts, sometimes AGI can be a little bit restrictive, but heck, not many people are choosing to gift that much. To be honest with you, over the history, I haven't seen that many come up, but it is something to consider for those who are making larger gifts.
Yeah, and no, that's a good point that, we do see, and it is a good strategy to sell or to gift the low basis stocks, because those charities sell it and there's really no capital gains being had anywhere. So again, that's a real big benefit of this strategy as well.
Yeah, and we've seen this a lot, Nick, with people who are, let's say they have a concentrated stock position, right? You have, we have clients who, who gifted shares of stock from their grandparents, and they have owned these shares for 20 years, and now it's a significant component of their portfolio. And so one of the ways to reduce exposure there is by gifting a little bit away, and it's just such a meaningful thing to do, and it's a relatively easy and straightforward process as well.
Yeah. So next we have donor advised funds, which we have a lot of information about this ship, mentioned. We have a whole webinar on donor advised funds. We have articles, we have podcasts on it. It's because it's such an interesting and helpful strategy and tool that people can use to do charitable gifting. And before we kind of get into it, Chip, can you describe what a donor advised fund is for people that might not know?
Yeah, and this is a wonderful tool, and it's simply an account. So custodians have they've established an account that's basically a donor advised fund, and you can go to Schwab, Fidelity, Vanguard, T. Rowe Price. All of these custodians have their own donor advised funds, and it's interesting, they're all a little bit different, and they have different minimums, they have different grants that you can give to the charities, but essentially a donor advised fund is simply an account, and you establish the account, and you can then fund it with an investment or other types of asset.
Yeah.
So just to elaborate on really some of the benefits there on donor advised funds. I mean, a lot of times people will, instead of gifting directly to the charity, they'll gift to the donor advised fund instead. And, the person making the gift to the donor advised fund would receive a tax deduction in the year that the contribution is actually made, which is really nice. But the gifts to charity themselves can be spread out over time, right? So let's say you have a situation where, you have a tax year you're in a higher tax bracket year. You make a gift into a donor advised fund in an effort to reduce, to get a nice tax benefit there, maybe put you in a different tax bracket. But the charities, you wouldn't have to give that full amount to the charity in 1 year. You can spread it out, which is really nice, because I can tell you that most charities, once you make a big gift, they think, oh, well, what about next year? What about the year after that? And so, this just is a convenient way to allow people to kind of spread those gifts out over time. And there are just tons of benefits with donor advised funds. They're really simple to establish. Custodians make it easy to transfer money in. There's a lot of investment flexibility. So, once money is transferred in, if you transfer in a low basis stock, that stock is sold immediately, and then it's reinvested in, and you've got a lot of flexibility in how that's invested. We are finding that the internal cost of donor advised funds is really very reasonable. And now it varies for each custodian. Now, they're not all created equal, but it is, relatively, there's some low cost options there. So something that we really like, to be honest with you. It's a great way to make larger gifts. And really, and we've written an article about this on our website, charitable bunching is what it's called. So, the standard deduction is such now that you're not getting, you have to gift quite a bit for most people to get above the standard deduction. And so what some people will do is combine 2 or 3 years of gifts into 1 year, but put it in the donor advised fund. That way you can itemize your deduction and get more of a benefit for the charitable contribution in that year. A couple of other points with donor advised funds, and it's really a great way to facilitate anonymous gifting. You can name your donor advised fund basically whatever you want. The Nick Faulkner Family Gift Fund. You can name it whatever you'd like, or it can just be anonymous. And so it's really nice to have that flexibility there. And what we've seen with our clients in the past, and really, and I think this is just beautiful, because it allows families to kind of get together and decide and make gifts together. It kind of facilitates this family idea of making gifts or grants is what it's called when you're doing it from a donor advised fund. But it's kind of nice to have that. And with any account, what happens when the original grantor passes away? With donor advised funds, you can assign a successor. And so it creates a situation where, there can be some continuity with families as time progresses. And it's just a really nice thing to do.
Yeah, and they're not all the same, right, Chip? Like there are certain donor advised funds that may be set up differently. It's not kind of like a one size fits all, right? There are different options or availabilities you can choose from.
Yeah, that's a great point. They're all a little bit different, and we've done the due diligence on tons of them. So if you have any questions, feel free to reach out. But I'll give you an example. The number one, the minimums are different. So if you have, like Vanguard, I think has a $25,000 minimum, but there are other vendors that have, $5,000 minimums, and so they're just structured a little bit differently. The other thing I think is nice is, their features are a little bit different. For example, there's one donor advised fund I know that allows you as the grantor to make an e-gift. And so what this is let's say you have a family member or someone who you would kind of like to get involved in the charitable gifting strategies with your family. And so you could say, okay, I want this other person to make a $1,000 gift to their charity. And so you could send them a link, and then they could choose the charities. And so, donor advised funds it's very automated. So you log on to your account, there's a lot of different types of charities, Salvation Army, Red Cross, whatever. And then you can also gift to churches and that kind of thing too. But, it's nice to be able to have different types of features, and not all are exactly the same. And so that's important to note.
Yeah, and so our next gifting strategy is qualified charitable distributions that Chip mentioned earlier. And this, this is extremely helpful for, people who are in the 70 and a half, 72 range to, it's just really another option that can be beneficial to you as well to give.
It really is. And, this is qualified charitable distributions are basically a way to allow you to make gifts from your IRA, right? So if you have an IRA, most of you know that every dollar that comes out of those accounts is taxed to you. So what you could do is say, pull money out of your IRA, be taxed on it, and then gift to charity. But, qualified charitable distributions allow you to, if you're above the age of 70 and a half, instead of taking money directly out of the IRA, you are basically gifting it to the charity directly. So it's never sees your tax return. So that's kind of a nice thing to do. And it starts at age 70 and a half, having that ability. And this kind of stems from the old required minimum distribution rules. If you're familiar with that, it used to be 70 and a half. Now it's age 72, but Congress didn't, the legislation was kind of passed in a hurry. So they didn't fix this part to coincide with this required minimum distributions. But what we're finding for people who are in the 72 years of age plus range, that it could serve to you can take that out instead of doing an RMD, and it takes the place of the required minimum distribution, right? So let's say you have $1 million IRA and your required minimum distribution is $37,000 for the year. Well, you could take the entire portion of that and give directly to charity, and then you're never taxed on that. And that's important because some people, are in situations where pulling money out of their IRA could impact other things from a tax standpoint, right? So Medicare premiums is a big one. The higher your income, the higher your Medicare premiums can be. And so it's important to understand that it's not just gifting directly to charity, which is great, but you can also save yourself some money in the form of Medicare premiums and also other things. It can allow for a tax benefit of gifting to charity if you aren't meeting the above the standard deduction threshold. So just kind of a nice way to do it. A couple of things, though, I think it's important to point out, Nick, right, is the order is important of this. You can't go and take your required minimum distribution out in the beginning of the year and then come back at the end of the year and say, hey, I want my second distribution to be the qualified charitable. I shouldn't have to take the required minimum distribution. So you have to kind of think through the timing of that. And so what we normally recommend people do is take your qualified charitable distribution first and kind of start that at the beginning of the year. And then once the qualified charitable has happened, then let's see, do you have anything left of your required minimum distribution? And so I think that's important to point out.
Yeah, and then we had a question, can you give your RMD to a donor advised fund?
You cannot give your RMD to a donor advised fund. No, that is not allowed. That is would be great, but the IRS does not allow that. So just keep that in mind as you're doing your planning. That is not something that should happen there.
Yeah. Awesome. So now that we finished with QCDs, we're going to move forward to charitable trust. And
one thing I just want to go back for just one
okay.
thing. I've got one thing that just popped in. Time is absolutely of the essence with these. We're kind of entering in the fourth quarter of the year, and a lot can go wrong with these. So if you're the type of person who wants to give to 10 different charities, you need to get on the stick with that, because we're seeing a lot of delays on the processing side, and it's a little bit of logistics, right? Because what happens is oftentimes you submit the paperwork to the custodian. When they process it, they'll mail you a check made payable to the charity, right? And so then it's kind of up to you to deliver to the charity and the check to get cashed. And so we don't want a situation where it's December 27th and the custodian just issued the check and there's no time really to get it to the charity. So you really need to get on the stick with these. So I just wanted to point that out. So sorry for that interruption, but
that's a good point, because we've had situations in the past where it's day after Christmas, 2 days after Christmas, and we're trying to get this stuff in for a year end, and the custodians are overwhelmed because everyone's trying to get it in a year end. So we really like to see those at the latest at the beginning of December.
And I'll tell you that we've also had situations where the checks were sent to the client in the summertime, and the client gave them to the charity, but the charity didn't cash them.
Yeah.
So, then it was like, okay, well, there's a huge penalty if you don't take out your required minimum distribution. In fact, it's 50% of the distribution itself. So you just want to avoid that. It can be costly, hassle, and time consuming. And so I just wanted to pinpoint that out before we go to charitable remainder trust. Yeah.
Yeah. Perfect. Yeah. And so these are, I would say, maybe the least used out of all of our strategies, but they can, again, for larger gifts, or maybe for some non-conventional, ways of giving, this can be an effective strategy as well.
Yeah, it really is. And, these can be, and I'm not going to go into all the logistics of charitable remainder trust because they can be complicated, but I'll tell you that for people who are thinking about larger gifts, it should definitely be a consideration. Now, I'll say that it's not as straightforward and simple as a donor advised fund or gifting shares directly to a charity, because it involves attorneys drafting documents, which is a cost, right? It can involve some time back and forth with making sure the structure is right. But once you've got the charitable trust in place, you can use that in ways that maybe that offers a little bit more flexibility than a donor advised fund. And it can also provide some additional benefits, but I'll tell you that normally what happens with these, you get the attorney to draft the document, you come up with the terms. A person gifts, you can give property, or some people can gift businesses, put shares of your own personal, closely held business in the charitable trust. And then once it's in the charitable trust, you can sell the asset that's there, and it's no tax on the gain. So there's no capital gains, but then the charitable trust itself can invest the proceeds. And, once the contribution is made into the trust, of course, the donor gets a tax deduction there based on the present value of the gift itself. And so the one thing that we like that's different from donor advised fund from charitable trust is that you can have a situation where the grantor can receive an income stream from that money. Now, there's some strings attached to that, but that's kind of the gist of how they work. Nick, anything you want to add there?
No, I agree. There are a lot of options. And again, if you want to go that route, we're more than happy to answer questions, but it does, there are a lot of ways where you can use these trusts to, give a stream of income to the charity, or you can receive a stream of income, or set out over a certain amount of years, or, there's even an option where you give it to charity until you die. And then when you die, it can go to your beneficiary. So there's a lot of different options that are available. So, if that's something that you're interested in, we're more than happy to discuss and talk about that as well.
Right. Yeah. And an interesting tool just to keep in mind. And it's something that, as our clients come to us and present these ideas, that's the direction we might head. And then we might plug them in with an attorney who kind of specializes in charitable trust and knows how to draft the best documents and that sort of thing. So we're kind of plugged into that. So we're happy to help in any way with any of these strategies, really. But the charitable remainder trust is kind of or charitable trust in general is kind of a specialty area. We're happy to help out.
Yeah, and so Chip hit on this, but we're talking about, again, time is of the essence, because as we talked about, especially if you're doing qualified charitable distributions, if that doesn't get out or something, heck, it may be lost in the mail for sending checks out, or like you said there, we've had a situation where the client received the check in the summertime. They thought it had been cashed by the charity that they gave to. And so that's something that, if you get it done on time, we really avoid those mistakes. And there are delays towards the end of the year. I mean, we see it, I know, John's listening in, but, we see it every single year where there are processes that are delayed at the end of the year just because of the magnitude of people trying to get these documents in. And so we really, really want to avoid that by getting it done as soon as possible.
Yeah. And brokerage firms, in general, are having problems with staffing. It's the same kind of story that we're seeing in other areas of our life with the pandemic and things. So, it's just the last couple of years have been really brutal for any of these things. Just, so we're just want to make sure that everything happens on time because, as we have mentioned, the cost of a mistake is so super significant. So we just want to avoid that if we can.
Yeah, perfect. And then, so now we're going to go into questions. I have one question. Do RMDs now begin at age 72 and not 70 and a half?
Yes, that is correct. 70 to age 72.
Yeah, and that's, a new law as well. And also we have what constitutes as a charity. And really that's anything that is most nonprofits, your churches, your universities, organizations like the Red Cross. What wouldn't count is donations towards political organizations. Those are really pretty much every time those are a no-no on as far as the government's concerned on charitable contributions. But most nonprofits are, however, it's you need to do your due diligence because you could get stuck in a circumstance where they're nonprofit, but not really a charity. So you really want to dig into that before you go and give a sizable gift if writing it off is something that you're interested in.
For sure. Any other questions or?
I don't think so. I think that's it for the questions.
All right. Well, I just reiterate that, this is an area that's complicated and, especially if you're trying to maximize the tax benefit of your gift, we're available to answer any questions. There's an email address there. You can call our office. I know any of our clients who are listening in on the webinar can, the door is kind of open to any of these things, and we're super happy to provide assistance.
And Chip, we just had another question come in real quick. instead for lower level funds, meaning like, lesser to donate, maybe not the hundreds of thousands, millions of dollars? When does it make sense to set up your own donor advised fund versus contributing to an existing one?
Well, we can talk about that if the person is super interested. I would say $5,000 would be my minimum. That would be the minimum. And really, there's a few custodians that have minimums that are 5,000. There's more that have minimums of 10,000. So I would say kind of in that range. And then, with a donor advised fund, once you've hit that minimum threshold, then you can gift, smaller amounts if you'd like. And, one thing I didn't mention is the level of the grant from the donor advised fund to the charity. And again, every donor advised fund is a little bit different there, but $50 I've seen, so the minimum grant. So let's say you contribute $10,000. Well, you can dole out $50 to charities, a number of different charities, and you can give anonymously, which is kind of nice if you think about, you're going to avoid the all the mail and that sort of thing that you would receive from that. So donor advised funds are a really great tool.
And then they, follow up. They said their goal, say their goal is $10,000 to give $10,000 a year, which I would constitute, okay, maybe we should look into a donor advised fund if it's that dollar amount. Could be a good option. Yeah,
for sure. Yeah, that's a good base level. And again, we can plug people into resources there. We are happy to do that.
Yeah. Awesome. Great questions. If you have any more questions, you can just email any of us or call us as well. So upcoming webinars, we have one almost a month from now, end of year tax planning, which this is, I would say, is one of the most important topics you could do a webinar on, just because it's so beneficial to do this tax planning at year end. And I imagine, or Aaron's going to be on that webinar as well. So that's going to be a really good one. And we've sent out newsletters to sign up for, and we'll have a link on our website as well. So just be on the lookout for that, December 6th. And then also check out our podcast, Finance in a Flash. We just did a series where we had an interview with Aaron and then one with Chip about how they started in the industry, a little bit insight on their personal life. And then we also did one on the history of Beacon Financial Strategies and how the firm started, what was the original intention, where they see it going. And we actually have one on every single person in the office if you want to learn more about us and maybe away from financial planning, what we're like and more of that. I think it's a good series. And all this is on iTunes, Spotify, Google Podcasts, our website. So those are all good tools. And we also have, information as well, like on donor advised funds and other topics as well. So it's a good resource to look into as well.
For sure. We try to be, provide that education and things to clients and visitors as well. So hopefully, people find that interesting. I know I really enjoy the podcast. I like talking a lot. And so, I think that it's something fun that we do that we really enjoyed. Looking forward to adding more content there. So please subscribe to that. I mean, if you're a podcast listener, subscribe. Give us a 5-star rating would be nice too. I mean, that would be great. But yeah, it's something we enjoy to do. So anyway, I think that's it. It's been a great privilege to have your attention for a few minutes, and hopefully you garnered a little bit, maybe a nugget or two of information that's helpful. But don't hesitate if you want to follow up, just don't hesitate to reach out.
Yeah, awesome. All right, everybody. Thanks for joining.